Dear students, welcome to Chapter 2. Now, arguably, this chapter is even more important than Chapter 1. Why? Because chances are, if you get a job in the United States, you're going to be confronted with an employer-sponsored plan, retirement plan. And 99.99% of them are going to have mutual funds as the investment choices. Now, of course, Chapter 1 is very important because it lays the foundation for our understanding of investments. But say you decide that you're not really interested in making your own choices, you don't even enjoy this stuff, well, then you still need to understand mutual funds because you're going to be investing in them. They truly are investments for the masses. And there's an industry saying, mutual funds will bore you to wealth. Yeah, when you're at a cocktail party and people are talking about their stocks, hot stocks they bought, or their cryptocurrencies, mutual funds are not the hottest topic of discussion. But that's fine. We love boring investments, in my humble opinion. So let's get started. What is a mutual fund? Well, we touched on these in Chapter 1. The legal term is investment company. Yeah, there are more types of investment companies than just mutual funds, but by far mutual funds are the most popular investment companies. The investment company invests its shareholders' money, your money, in a diversified portfolio of securities, stocks, bonds, whatever, on your behalf. Mutual fund is the popular term, but you won't hear investment company unless you work in the industry. Now, what are the two wonderful things we get from mutual funds? We get professional money management and diversification. Now, there are some people who will say they'll poo-poo diversification. And you know what? Those are the speculators. Those are the traders. Those are the people who are trying to make eye-popping returns quickly. They want to get rich quick. And they've probably already left the class or stopped reading the book or whatever, because we really can't help them very much. For the vast majority of us investors, diversification is a good thing. And there are also individuals who will tell you that professional money management ain't all it's cracked up to be. And, you know, there are good professional money managers and there are not so good professional money managers. And part of our task as mutual fund investors is to find the ones that have a long track record of consistent results. Exactly. Well, the problem is there's 12,000 of these darn things. What, 12,000? I mean, are there 12,000 different breakfast cereals in the grocery store? Well, it seems no. There are 12,000 different types of cars? No. Why are there 12,000? Well, we're going to hint at that reality and then dig deeper into it. But the truth is, choosing a mutual fund is just not easy. There's just too many choices. But once you've chosen your mutual fund, there's nothing more you have to do. They do the work for you. They want to get paid, and that's the subject of our second presentation. Many people choose mutual funds for their retirement accounts, their 401ks, 403bs. Those are employer-sponsored plans. Traditional IRA, the Roth IRA, that's your own investment plan. Saving for college, saving for a home. Yeah, they are the investments for the masses. Slide number 3. Now, if you remember the graph, the professionally done graph from Chapter 1, well, this is my offering. And Mr. Ferrin was very kind to do it in a much better way. But I like mine, actually. It's not so bad. Here we are. We're the little people. I'm really good at making stick figures. And more of them are women. More and more of us investors are women. Because women are figuring out, guys aren't all that's cracked up to be when it comes to investments. And we give our $100, $50 a month, whatever we have, to the people in the top hats. These are the mutual fund managers. And luckily, more and more of them are women. What? It turns out, sorry guys, statistically it's already been shown that women make better investors than men. I will let you decide why that is. I have my own ideas. But no, it's already been shown. Women do better overall than men as investors. And we'll discuss investor psychology later on. Now, what do these mutual fund managers do? They create a pool of money, a mutual fund. And I know it kind of looks like a potato. My apologies. But it's meant to look like a pool. And these pools are huge, billions of dollars. So they then will decide what to invest in. And if they invest in stocks, it's called a stock mutual fund. Tricky how that works. If they invest in bonds, it's called a bond mutual fund. If they invest in the short-term instruments, short-term investments that we discussed in Chapter 1, it's called a money market mutual fund. But usually the mutual fund disappears. You just hear people call it a money market. And what we begin to see is the bifurcation, if that's the right word, I don't know, the explosion of different types of mutual funds. Because way back when mutual funds started, people got the idea, well, why don't we mix the two? Why don't we create a balanced fund of stocks and bonds, which is actually a pretty cool investment, which we'll discuss much later on, and the reasons why. But it gives us some growth and some stability, yes. So again, if somebody were to wake you up at 2 o'clock in the morning, what are the two most important reasons that investors like mutual funds? Professional money management and diversification. Because they don't just buy 10 stocks or 20 stocks, which is about all one person can handle. They buy 200 stocks. They have entire teams, people all around the good ones, have investment professionals all around the world speaking many different languages. Because the world is global, folks. That's right. Remember Coca-Cola? 80% of the revenue comes from outside the United States? Right. Slide number 4. Here's the growth of the industry. Now, there were mutual funds that actually started back in the 1920s in the United States. The idea came from the Scottish Investment Trust, is it called? Which has been around since the 1880s. You got to go check that out for me. I'm not sure I got all the numbers right or the name right. But yes, the Scots started with mutual funds back in the 1880s. And then the idea in the 1920s was to bring that professional money management and diversification to the United States. But it wasn't until 1940 that the Congress caught up with the industry. Because at first, the IRS and the state regulators were trying to, what is this thing? What are these mutual funds? We don't know what to do with them. And notice there were only 70. 30 years later, it had grown to 350, 600 by 1980, and then the explosion happened. In the 1980s and 1990s, we went to 2,000, and then by 2000 there were 9,000 of them. And in the last quarter century, we're up to 12,288. Now, the data for this comes out in May. It comes out in the Investment Company Institute, ICI.org's annual mutual fund fact book, Investment Company Institute fact book. So we're looking at 2023 data, but the 2024 data will be even a little bit more impressive because 2024 was a pretty good year for stocks and not so great for bonds. So the Congress can work together. They can play nice in the sandbox when they do. And they were able to create the Investment Company Act of 1940, which we'll see in just a couple of slides. So now we're on slide 5. And we're going to see that in 1980, there were 5 million Americans that owned mutual funds, holding just 3% of their household financial assets. As of December 2023, over 120 million Americans in 71.5 million households owned mutual funds. That's almost 55% of all U.S. households. Why is that? Again, because of the growth of employer-sponsored plan. You see, before the 1970s and 80s, you worked at a company and they were the ones who were responsible for your retirement plan. They made the choices. But oh, there it happened again, folks. I apologize. This closed captioning keeps ending on me, and I might just stop using it and have you decide to choose YouTube and have YouTube automatically do the closed captioning, because I've restarted a few presentations already this semester, and I ain't gonna do it no more. No more. And of course, if you do need closed captioning, immediately contact me. Immediately contact DSS. We will get the service on board. 3C Media Solutions, and they create ADA compliant closed captioning. So before mutual funds became very popular, people just did not do their own savings for retirement. It was the company. Now it's on you. And we talk about that later on in the semester, late in the semester, and in the BUS123 Principles of Money Management class. The onus on saving for retirement is you, and mutual funds are the typical choice. Notice now, mutual funds are holding $33.6 trillion of, trillion dollars of people's money. And that's 22.6 of the household financial assets. So mutual funds now are the nation's largest financial intermediary, which is a fancy word for they hold on to somebody else's money. Followed by who you would thought would be number one would be the banks, but no, they're second. And life insurance companies, yes, life insurance companies are often called the invisible bankers. So mutual funds are a very important part of our financial industry. Here is the growth of their assets from 2007. Notice what happened in 2008, right? 13 trillion in 2007, 10.4 was 2008 was a bolt of lightning from the sky, but it didn't deter us. We came back until what happened in 2022 was a little bit of a drop. I'm sorry, 34.5 down to 29.9. That was when inflation, the COVID inflation hit, and stocks and bonds both went down. And as of the end of 2023, it was 33.6. Now, when we get the data for 2024, we're going to see that that's it's a lot more now. Not a whole lot more, but I think it went up 20-some%. So it's going to be a couple $1 trillion more at the very least. So my goodness, that's a lot of money. And so people are counting on the mutual fund industry to help them save for retirement, save for education, save for a house, build wealth, whatever. What are the advantages? Well, we already told you the two most important advantages, that if we call you up at 2 o'clock in the morning and say, what are the two major advantages of mutual funds? You say, it's diversification and professional money management. Diversification is a good thing. It is a process whereby investors buy a diversified portfolio of securities for the collective benefit of the individual investors. This variety provides some safety that is difficult for an individual investor to obtain on their own. And then, of course, you're paying these people to manage your money, and they are supposed to know what they are doing. They're certainly getting paid well enough. Another cool thing about mutual funds that we don't think about until we have to get around and start investing is that we don't need a whole lot of money. $25 a month, $50 a month. It used to be that it was kind of difficult to start investing in stocks unless you had it. The brokerage firms want you to have several $1,000s, but $500, $1,000. But now some brokerage companies have made it easy for you to start buying individual stocks with fractional shares. So you don't need, one company, their shares might be $400. You can buy, 1/10, $40 and buy 1/10 of a share. But it is an initial outlay of capital. Sometimes I'll be talking to people and they say, well, I don't really have enough money to invest. Can you afford $50 a month? And they go, I said, what's your cell phone payment? Well, it's supposed to be 40, but it winds up being 80 because I download a lot of ringtones. And then finally, the coolest thing about mutual funds, once we've managed to choose a darn one or two, is the PETA factor. Now, I wish I had come up with this, but I have to admit it was David Chilton who wrote The Wealthy Barber, which is a phenomenal book, folks. The numbers are all wrong. He wrote it back in the mid-'80s, 1980s. But still, the concepts are brilliant and timeless. So do read The Wealthy Barber. It's still available at your library. You can get it for dirt cheap off the infernal net. The PETA factor. Pain in the... yeah, right. Again, once you've chosen your mutual fund, there's not much for you to do. Check it every 6 months, a year, whatever. Yeah. Now, what are the disadvantages? Well, guess what, folks? These people are not doing this for their health. I mean, I guess they are doing it for their health, because if they don't get paid, they can't buy food. And if you can't buy food, you get sick. But no, these are not non-profit organizations. They're out to make a buck. So they will charge you. All of them, except for, we'll see a couple examples, but they're charging you an annual operating expenses. And they range from less than 0.5% to 2% or more, which means, for every $100 you have in the account, 50 cents or $1. 0.5% would be 50 cents. 1% would be $1. 2% would be $2. Now, it might sound like a lot of money, but your bank is charging you a lot more, and so is the life insurance company. So, yeah. Now, some mutual funds have transaction costs. They go by various names: sales charge, sales commission, sales load is the traditional term. And then many others are no-load funds. But we have to be careful. Some no-load funds can wind up costing you more than load funds because of the annual operating expenses. You have to see both sides of the coin. You have to see what they're charging you up front, if they are, and what they're charging you every year in perpetuity. You like that word, perpetuity? It means forever. And then many mutual fund managers do not match the market's performance. Wait a minute. Aren't the mutual fund managers supposed to know what they're doing? Well, there's a lot of reasons for why they don't match the market. Because first of all, what's the market? You have to pick and choose. And also, different strategies are going to yield different results, especially when you have this huge spectrum of risk versus return in your mutual funds. So we'll discuss this in more detail as we go along. And the truth is, some just don't do that well. Why are the reasons for that? Well, not everybody is a Pavarotti. Not everybody is a Wayne Gretzky. Choose your favorite opera star or movie star or sports hero. Yeah. Some people are better at doing what they do than others. And the competition is incredibly fierce. Slide number 9. Now, you're in an introduction to investments class, so you need to get out that study guide and learn about the difference between open-end and closed-end funds. The reality is, though, most people will not choose closed-end funds. I mean, some people still do, but they're losing their staying power in the industry. They're disappearing over time. By far, the greatest number of mutual funds are open-end mutual funds. Now, you're going to hear people use the term mutual fund, and 99.99% of the time, unless they say closed-end or the other one, the ETF that we'll discuss in a bit, they mean open-end mutual funds. Open-end mutual funds constitute about 70% of all the mutual funds in existence. They're a type of investment company in which the investors buy shares from and sell them back to the mutual fund itself. There's no limit on the number of shares, so the more money comes in the door, the more shares they can send out the door. And then when you want your money back, you redeem the shares, you sell the shares back to the mutual fund company, and they send you your money. So we use the word shares are issued and redeemed. The words issued and redeemed. But you can think of it as purchasing and selling back or redeeming them. The investors buy the shares from, they're issued to you when you send your money in. And you then, when you want your money back, you redeem the shares. So you hear people talk about redemptions or just sales. As we said, excuse me, when people refer to a mutual fund, They are almost always exclusively referring to an open-end mutual fund. As of December 2023, there were over 8,500 of these things, totaling $25.5 trillion in assets. So you will hear some people say, mutual funds are all going to disappear. Right. The reports of my demise have been greatly exaggerated, as Mark Twain would say. Slide number 10. The other type of mutual fund traditionally was a closed-end fund. Notice that they're only a little over 3%, and their numbers have been steadily shrinking. They're a type of investment company that operates with a fixed number of shares. Shares are issued when the fund is organized. And after they are all sold to initial investors, new investors have to buy them from other investors. So you see, these are more like how stocks work. And we'll discuss how stocks work in the next chapter. But 5 million shares or 50 million shares are issued to the public. And that's it. Then investors buy and sell them from each other through the marketplace. They're not as popular as open-end investment companies. And as we say, their numbers are shrinking. There were only 402 of these still left in 2023, holding only $249 billion in assets. So you see, one has T, trillion, and the other one has B, billion. And as we said, their numbers are steadily shrinking. So now, what is the net asset value on slide 11? Well, the net asset value, you probably won't hear that term unless you work in the industry. You'll just hear people say, "What's it worth? What's the price?" It's the underlying value of one share in a particular mutual fund. Now, how do they calculate this? Well, you don't have to do it. I'm going to show it. I'm going to show you an example on the next slide, but it's not something you have to do. It's done for you every business day. They add up the value of the securities in the mutual fund, subtract any liabilities, which is normally close to zero. They have to pay the rent. They got to maybe some investors ask for their money back, whatever. And then you divide by the number of shares. Open-end mutual funds are sold at net asset value, and if they have a sales charge, a sales load, a sales commission, that's added on to the net asset value. Since closed-end mutual funds are bought and sold on the open market, their price usually reflects either a premium or a discount to the net asset value, and it's usually a discount. It's usually not much, 25 cents or so. They are very rarely priced at their net asset value. So some people say, hey, look at this. It's worth $25 and I can get it for $24.80 or whatever. Well, so what? You have to turn around and sell it. It's probably going to be 20 cents less than what the net asset value is when you sell it. Maybe not. It might sell at a premium. You don't know. But it's never going to be very much, folks. It's never going to. At least I've never seen it, and I've never heard of it ever being. We should look that up. Okay, here's the calculation that we talked about on slide number 12. The net asset value is equal to the value of the fund's portfolio, and every day, every business day at 4 o'clock New York time, 1 o'clock California time, a bunch of people at every mutual fund get together and gather up all the information about their portfolio and come up with a value. You subtract out any liabilities, what has to be paid, people have to be paid their payroll, whatever, the lights, the electricity, and then you divide that by the number of shares. So if the value of the portfolio for this example were $10,050,000, and we had to pay somebody $50,000 for whatever reason, that would be $10 million. Well, if there's 1 million shares outstanding, we would divide the million into the 10 million and get a $10 net asset value. And that's where you're going to see NAV, usually in caps. And then the offering price, if there were a sales load, a sales charge, a sales commission, would be added to that. So let's say it's a 5% sales commission. That would be 50 cents. So the offering price would be $10.50. Again, you don't have to worry about this. It's all computed for you. And most people, unless they work in the industry, are not going to use these terms. So that's what you're up against. My apologies. But some of you, I'm certainly hoping, I'm praying that some of you wind up in the industry because we need more professionals. They need more women. They need more bilingual, multilingual, minorities, and they love veterans. So think about it. Did we mention the salaries are higher than national averages? Mm-hmm. Slide 13. So what are the advantages and disadvantages of open-end versus closed-end? Well, open-end funds are, just really, really flexible. You can buy and sell anytime. They're very popular, wide range of choices. But now we have to think from the viewpoint of the mutual fund manager. It's not our problem as the investor, but it's the manager's problem. What if a mutual fund does really, really well? Well, then they're going to get showered with love and attention and a whole lot of money. And so all of a sudden, all these billions of dollars are coming in the door. What are they going to do with it? They have to go put it to work. They go out and buy more of what they already own? Do they find other things to buy? For that reason, many mutual fund companies will close a fund. It will say, this fund is closed to new investors. If you're already an investor, fine, you can contribute more, but no more new investors. Other companies say, no problem, we'll just add more managers. So you wind up with a mutual fund where you have 8 managers, and each one is managing their own part of the portfolio. Yeah, different companies deal with it differently. The same thing happens in reverse if there are large redemptions. Say the mutual fund didn't do very well, or maybe the market falls and people are panicking and starting to take their money out. Well, now the mutual fund manager has a serious problem. They've got to sell some of their investments at the worst possible time. Right? They don't want to sell now. Now's when the markets fall. Now's the time to be buying. But the mutual fund has they can't hold on. They can't go back to the investors and say, hey, can you guys wait a few months until the market comes back? No, you can't do that. So that's an issue with open-end mutual funds. But it's not an issue with closed-end mutual funds. Why? Because once the 10 million shares or however many million shares have been issued, right, the mutual fund company just keeps doing its work. It's up to the individual investors to buy and sell. So that's not an issue with closed-end mutual funds. They're easier to manage for the investment advisors. But you got to pay a broker's commission like a stock. You got to go out in the marketplace and buy them, and they're often sold at premium or discount to the net asset value. Plus, as we saw, there's just not that many of them, and the number of them is shrinking. Yeah, okay. Which would you prefer? Well, in your 401k, it is very unlikely that you ever see a closed-end mutual fund. They're going to be almost all open-end mutual funds. Slide 14. Now, the new kid on the block, which is actually not that new. They started back in the 1990s, are ETFs, exchange-traded funds. And they are roughly about a quarter, and their number is growing. They're becoming more and more popular. And we'll see a few reasons for that. They are a hybrid. They're an open-end mutual fund, which means that they can issue as many new shares as they need, but they trade like a closed-end mutual fund. They trade on this exchange. So there's the stock exchange. So there's no limit to the number of shares, and you can buy and sell them throughout the day. Unlike open-end mutual funds where there's only one price at the end of the day. But now you incur brokerage transactions, commissions through your brokerage firm. And some of you might say, well, I have Robinhood and I don't pay any commissions. Wrong. Stick with us if you have Robinhood. At least make it through chapter 3 to learn that you are being charged, dear students. Oh, yes, you are. Now, some of these companies like Fidelity's a brilliant marketing company, and whatever they do, Vanguard does. They have opened up their sister companies, which are brokerage companies. And mutual funds are not brokers, not brokerage firms. So they open up I think it's called Fidelity Brokerage Services, right? But it's got the name Fidelity, and Vanguard has theirs. And if you buy their ETFs through their brokerage firm, they waive, WAIVE, the transaction costs. Cool. That's pretty cool. Yeah, I think it's very smart. Introduced in the early 1990s, ETFs have become very, very popular. We will discuss some of the reasons why later on. Now, you have to be careful. There's a lot of confusion. We're going to talk about active management and passive management. The first ETFs and the vast majority of ETFs are passively managed index funds. So people just assume that all ETFs are index funds. No, there are many ETFs that are actively managed. They have the people in the top hats. And we'll discuss the active versus passive management in detail later on. Look at the ETF industry. Look at how it's grown since 2006. Just even with 2008, the number of dollars fell, but the number of funds continued to grow. And as of the end of 2023, they have $8 trillion, a little over $8 trillion of assets. So they are definitely gaining on the open-end mutual fund industry, but still 1/3 the size, folks. So if anybody tells you that mutual funds are all going to be gone soon, you just nod your head and say, sure, buddy, sure. Slide 16. Now, we made mention of the Investment Company Act of 1940. It's proof positive that the demagogues and the Republicans can work together nicely in the sandbox and get things done. So we have to hold them to it, folks. We have to tell them, you got to work together. Anyway, slide 16. The Investment Company Act of 1940 was the foundation of the modern mutual fund industry. As we said, these things were already around, but the IRS and regulators didn't know, they weren't sure exactly what's going on. Well, it defined, this act, a regulated investment company. Again, mutual funds are just one type, but they're the biggest type. It's a pass-through investment vehicle. What does that mean? Look, whenever you make money buying and selling stocks, the IRS, says, hey, you owe us money. And the IRS would go to the mutual fund and say, no, the mutual fund says, no, you don't understand. It's not our money. We're doing this on behalf of our shareholders. Go tax them. Okay, we pass through the gains, the capital gains, the rent. It's REITs. The dividends, interest, we pass them through to the investor, and the investor pays the taxes. Okay, all right. Now, of course, the mutual fund makes money, but that's separate from your money. In fact, the first thing they teach you when you get into the industry, as you're going through your training, is you never commingle your money with your client's money. Never, never, never. And that's what we made mention of the mutual funds when they the money market mutual funds, when they break the buck. That's the exception. They allow them to say, okay, you guys screwed up on behalf of your clients. You can put some money in. But no, you never do that. To qualify as an investment company, the investment company must hold almost all of its assets as investments in stocks, bonds, or other traditional securities. And there were very limited ability to use derivatives and other risky strategies. Well, lately, a lot of these, as we're going to see, very aggressive mutual funds have been getting around this. I don't know. I don't follow them. I don't want to know. They're too dangerous for me, and I would never recommend them. But no, stocks are risky enough, folks. So the Investment Company Act said, that's it. You got to put money into stocks, bonds, or other types of traditional securities. And use no more than 5% of your assets when acquiring a particular security. What does that mean? Well, if you cannot use more than 5% of your assets, if you take 100% divided by 5, that means you have to have at least 20 different stocks, at least 20 different bonds. But as we said, usually they have 100 or 200 or more of stocks or bonds. But that's the bare minimum. And there was a fund called Janus 20, we'll come back to it later, where they said, hey, we're going to have about 20 stocks. Not too smart. Well, it's great if those stocks do well. Not so great if they don't do well. And so we'll discuss that in more detail. But just think, folks, we buy mutual funds for diversification. We want at least, we don't want more than 20. We want at least 100 or so. So think about it. One company goes bankrupt, it's not the end of the world. It's not going to kill you. Whereas if you only have 10 stocks, oh boy, there you go. There's 10% of your portfolio right there. And the mutual fund must create an organization with checks and balances. Have you heard that term? Did you ever take civics back in high school? That's what our government's supposed to have, checks and balances, and there's somebody who's trying to get rid of all of them. Slide 17. Here is an organization chart for a mutual fund. See, a mutual fund is not just one company. It's actually several. It's an amalgamation of companies. The shareholders are at the bottom here. Here we are. We're the shareholders. And we elect, believe it or not, a board of directors. And the board of directors are responsible for overseeing the management of the fund on behalf of the shareholders. Now, they're not responsible for the choices of investments, but they're overseeing the fund to make sure they're doing what's best for the shareholders. There has been some complaints over time that some of these boards are just turning a blind eye and rubber stamping, so to speak, whatever the investment manager wants to do. But that's, the exception, not the norm. 75% of the board must be independent of the mutual fund organization. So these are the people, they're typically ex-executives from the industry, or maybe politicians, and maybe some people from academia who've shown themselves to be, very, what's the word, up forthright and have lots of integrity. And what do? They oversee the fund. Now, the fund is broken up into 5 different parts. The most important part are the people with the top hats, the management company, which does the research and chooses the investments in accordance with the fund's objectives as outlined in the mutual fund prospectus. The mutual fund prospectus says, this is a growth fund. We will strive to be 80% invested in typical growth companies. Or this is a bond fund. We will invest in corporate, high quality corporate bonds. And so the management advisor, the management company, does that. But do they actually hold on to the shares? Oh, no. They just make the decisions. A custodian is a separate company that holds the investment choices. It's often a bank or a trust company. In fact, one such company, State Street Bank, well, I forget now it's called State Street Research, but that was their bread and butter. You want to start a mutual fund? Hey, we already got the custodian part all sewn up, and we'll do it for you. The distributor is the company that is responsible for the distribution, the sale of the shares through brokerage firms or directly to the public. They are sometimes called wholesalers because they go to the brokers, the financial representatives, whatever you want to call us, the advisors, and they represent the mutual fund. And they say, hey, this is what we offer here. You got any clients that need this kind of stuff? Or they go directly to the public, or both. Right, because some companies deal through brokerage firms and through the public directly. And then the transfer agent is the company that processes the purchase and redemption orders from brokerage firms and from individual investors. Now, there's another entity, which is a separate entity called the Independent Public Accountants. You might have heard of the Big Four. It used to be the Big Eight. Now, Deloitte and Touche, Ernst PricewaterhouseCoopers, Ernst & Young. These are companies that come in every year or so. I'm not sure exactly how often they do it. Obviously, at least once a year. And they say, okay, you say you have 100,000 shares of Microsoft. Where are they? Okay, go to the custodian. Oh, here they are. And so they make sure that the numbers are on the up and up. You might have heard of Bernie Madoff, who made off with about $13 billion. His independent public accountant was some guy in Connecticut working out of his garage. Yeah, no, I did. If you deal with a reputable mutual fund company, folks, no, they're going to be using one of the KPMG or one of these big accounting firms. So the next couple of slides are just describing the what we just saw in the picture. The mutual fund is a corporation run by the board of directors on behalf of the shareholders. They oversee the fund's operation. They're trying to look out for the shareholders' best interests. The investment advisor, those are the people in the top hats. Portfolio managers, they're called, sometimes called star managers because they work alone, or they might work as a team or a committee. I like a team better. And then research analysts are the people who go out and knock on the doors and, knock on the doors of Ford and GM and Chrysler and Toyota and Honda and Mercedes-Benz and Tesla and all the different companies, and come back to the portfolio managers and say, we think Ford's going to really do well. The custodian actually holds on to the securities, bank or trust company, and then the distributors distribute the shares to the public or through brokerage firms. Mutual funds are technically what are called initial public offerings, continuous initial public offerings, because they're always able to issue more shares. And we'll discuss IPOs, initial public offerings, in Chapter 3 when we get to stocks. The transfer agent keeps track of the purchases and redemption requests from the shareholders, and the independent public accountant firm will certify the fund's financial operations and reports. Why the large diversification of tasks and companies? Well, dear students, mutual funds are highly regulated in order to protect shareholders' investments from fraud and collapse. How often have you heard of a scandal at a mutual fund company? Until 2003, you never heard what? Wait a minute, Piano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, yes, as a matter of fact, I do. Since 1940, the mutual fund industry has been regulated and escaped any hint of impropriety. You like that word, impropriety? It means hanky-panky, travesuras, trucos, stealing. In 2003, some practices that were not quite illegal, but obviously unethical, were uncovered. It was only a handful of funds and people in the industry, folks. It was not widespread. But that doesn't matter, does it? No. You hear of one restaurant that has a outbreak of some whatever. Everybody stays away from all restaurants. There was a company called Strong Funds, started by a guy named Richard Strong, and he was an amazing gentleman who had built this company from scratch. He was worth, I forget how much, $600 million or $800 million at the time, and he was involved personally. He was barred from life, from the industry, and was very contrite. Said, "Look, I ruined my life. I ruined. I let down all the people around me. Why? Because I started to believe everything people were saying about me." Two people at Putnam. No, two people at Alliance. I'm sorry, Alliance. Two people out of the whole company. And Alliance has got some really good funds. We're going to take a look at one of them next chapter. But they almost disappeared. The whole company almost disappeared. Bank of America, Janus, well, I can't expect that from them. But Putnam, poor George Putnam, rolling over in his grave. And Putnam almost disappeared. So what were they doing? Well, if you click on the link there, practice is not quite illegal, you'll see. They were shaving thousands of pennies off of their fellow shareholders' accounts. Huh? How did they do that? Well, it's a little tricky, but you can read about it. But think about it, folks. If the market tanks in the U.S., chances are, it doesn't always happen this way, but this is what's been happening lately, last few decades since the 1980s. The markets close at 4. So say it went down 2%. Chances are that when the markets open in Japan just a couple hours later, they're going to fall. But the prices are fixed at the New York time. So you see the market falling in the New York, you sell your Japan fund, you sell your Japanese fund, and the next day you assume the Japanese market's going to fall along with the United States market, even though it took several hours to do so. You buy it back. You see what you did there? You're starting to use mutual funds as trading vehicles. Well, first, you shouldn't be doing that. I mean, that's what ETFs are for. ETFs are now being used as trading vehicles. But open-end mutual funds, no, you're not supposed to do that, folks. And so they weren't stealing a lot of money, but if you have 1 million investors, right, I think Mr. Strong made a couple $100,000, but he was worth 600 million. I mean, why would you do that? It just doesn't make any sense. Now, many of the companies just said, no, we're not, American and Vanguard just said, no, you can't do that. American, if you sell a mutual fund and then you want to buy it back, you have to wait 30 days. Sorry, we don't want you to be playing this game. Other companies like Franklin and Oppenheimer, which is now part of Invesco, they say, sure, you want to do that? Go right ahead. We'll charge you 2% and give it to your fellow shareholders. So they discouraged it by doing that. So you see, most of the companies just did not engage in this. They just thought this is ridiculous. And so now it's kind of moot because you can use your ETFs. You can do trading with ETFs, which, by the way, is something that John Bogle and we made mention of him in the previous chapter, who was the co-founder of Vanguard. He really did not like ETFs for that reason. He just thought, no, this is we don't want people trading mutual funds. Well, it's not his control. It's out of anyone's control. I mean, they're available for buying and selling on the exchanges just like stocks. So hey, you can buy and sell to your heart's content. And if you believe you're getting zero commissions, think again, dear students. Now, okay, time for a break, right? What do you think? Are you convinced that mutual funds are investments for the masses? Go back over and review all this. Get out that study guide. You're going to be the investment guru for your friends and family and coworkers, and it is a very important responsibility. And we are very, very proud of you. So be awesome, because in our next presentation, we're going to tackle fees. Yeah, these are not non-profit organizations. But we're going to find that some mutual funds charge a lot and some don't charge as much. And what's the most important thing? How well do they do over the long term? Again, as always, thank you for being in our class, and bring honor and glory to Southwestern Community College, your family, your friends, your colleagues, and of course, yourself.